Well, good morning and welcome to the March edition of NAIFA Live. We're coming to you live from the NAIFA headquarters in Falls Church, Virginia. I'm your host, Brian Money. We have a great speaker lined up for you this morning from our host location in
Brian, hold up, sorry.
Okay, so some of you are joining us virtually from one of the 19 watch locations across Iowa, Minnesota, and North Dakota. Let's take a minute and see who's out there. All right, everybody wave. Welcome to your NAIFA meeting. Before we begin the program, I have a few housekeeping items to go over. Today, 2 CE credits are approved for participants in Iowa, Minnesota, North Dakota, New Mexico, and Nebraska. If you're participating from a NAIFA viewing location in one of these states, a qualified proctor is on site now to monitor, document, and testify to your 100% participation and completion of the course. For those of you joining us virtually, with the intent to earn CE credits, you must remain present for the duration of the program. Throughout the program, polling questions will appear on your screen. You'll have 2 minutes to answer them in order to attain the CE credit. The first polling question for our virtual viewers is, how many years have you been in the business? How many years have you been in the business? You'll have 2 minutes to complete. Go ahead. Keep going. You'll have to wait just 2 minutes. NAIFA Live will be held every month. Please mark your calendars for the next meeting on April 18th, hosted by NAIFA Iowa. This meeting will feature Jonah Stillman presenting Gen Z in the insurance profession, how the next generation will transform the insurance profession. Now it is my pleasure to turn the program over to NAIFA Iowa past president, Keith Hennessy, who will introduce our first speaker. Keith, take it away.
Welcome and good morning, NAIFA membership. NAIFA Iowa is pleased to host the third in a series of monthly NAIFA Live events. Now, without further ado, it's my pleasure to introduce Rick Cordaro. Rick?
Thank you. Am I good? Terrific. Good morning, everyone. I'm glad that you're all here personally and at the meeting sites and all around the country joining NAIFA. I do want to thank NAIFA for giving me the opportunity to extend the message about income replacement. I also want to thank my friends at Principal for being the host, and Lori, you've done a terrific job and a lot of work involved. I know there's several meetings going on as far as making sure this microphone works so you can hear me. So that's kind of interesting. But let's go ahead and get started here. We're going to divide this process or presentation into 2 different hours. Oops, I've got to turn this on here. And what we're going to talk about in the first part of the presentation today is talking about individual disability income and why do we have it? Why is it important? How does it work? And then talking about some examples of that. And then on the second hour, our second presentation, second part of the presentation, we're going to talk about the business aspect of it and how that can be utilized in both qualified sick pay plans and executive benefit plans. Kind of, we know it's important what people buy, but how they buy it is equally as important. But let's go ahead and get started. What is income protection? And before I get into this, let's talk about what we do as an industry. I've been in the industry well over 35, 36 years. And what's kind of interesting for me is that I try to keep things very simple. I learned very on that try to focus on something, make it something that I can understand, that I can clearly talk about. And in our business, we help people manage risk, and the risk kind of default into 3 different basic areas. Number 1, the financial risk associated with dying too soon, the financial risk of living too long, and then the financial consequence and the financial risk of becoming sick or hurt. When we look at what we do, obviously the risk of dying too soon is that miracle product we call life insurance. And I'm a big fan of life insurance. I understand it. I get it. And I think it's like I said, it's a miracle product, but it develops and creates the right amount of money at the right time and puts it in the right place for families and businesses in that situation where an individual were to die. And then obviously the risk of living too long. People can, the worst thing that could probably happen to people is they outlive their money. And many of us are in that business of helping people save for the financial consequence of living too long and in retirement. We do that with 401ks and pensions and all these different types of things. But what we want to focus on today is that financial risk, the consequence of an individual who becomes sick or hurt and they're not able to create and generate an income. And this, my friends, is, I think, the most important thing, because when you look at everything we do, the financial consequences associated with death and living too long, those are terrible. And don't get me wrong, they're important. But I think the financial risk of an individual becoming sick or hurt and not being able to continue their income, this is something we all need to obviously start to be focusing on. Okay, I'm not able to move my slides here. Or am I? That's all right. Nope, that's moving my slide, but it's not on the screen here.
Bear with us a second, guys.
Okay, 1 minute. I'm going to go ahead and get started and talk about this until we catch up. Oh, here we go. Here we go. Perfect. What is income protection? Obviously, we all know what income protection is. It's a product best known as disability income insurance to help the clients insure their most important asset, and that's their ability to get up every day and do what they do and earn their paycheck. Okay? So it helps people obviously protect their mortgage payments, car payments, student loan payments, credit card payments, all the things that are associated, those financial obligations that these individuals have, okay, when and if they do become sick or hurt, they're not able to work and maintain their particular lifestyle. And this is important to understand, to help people understand the consequence of not having this, okay? And a lot of people equate, when they're talking about income replacement, you know, Mike, they may say to you, how much can I buy? Well, you can buy $5,500 of monthly benefit. That's what you can get. Well, I think what we need to do is try to transition that $5,500 to say, well, what does that $5,500 represent? Okay, here's the things that we're going to be able to do for you. We're going to be able to continue to make your house payment. We're going to continue to make your car payments. We're going to let you continue to have your children go to the college that they're going to, or where they want to go. Are you going to be able to continue your health care coverage? Or maybe continue your, maybe put money in for retirement, or all these different things. What does money do for you? I mean, we always equate things to the dollar amount, but what does it mean to people? What does that really mean to me? What am I going to lose? What's at stake here? Are you willing to give up your home? Are you willing to give up your cars? Are you willing, do you want your spouse to get a second job? Do you want to really pull your kids out of college? I mean, those are the things that you really kind of have to help people understand, that there's a consequence. If they become sick or hurt, that it's not about it's about the money, but what does that money do for you? Okay. You know, interesting enough, when you talk to, when I talk to people, it's funny, I can ask them, what are your kids' birthdays? Well, they'll have to think about it. They may have to check their phone, this type of thing. But ask them what they, do you know what day you get paid? Boom, right there. I get paid on the 1st, I get 15th. I know at 2:45 in the afternoon, that check's going to show up in my bank account. I may know exactly when they're going to get paid. Why is that? What is their paycheck important to them? And the thing that, we have, for the longest period of time, people say to me, Rick, I get it, but I don't know how to have that conversation with my customer. How do you have a conversation with a customer to get them thinking in terms of, yeah, this is important? And, we've tried to find that magic term, the thing that's going to say, oh, everybody's going to buy after I say this. But, just simply look at your customer in the eyes and say, hey, if you were to become sick or hurt tomorrow, I need to know what your plan is. That's it. Tell me what you're going to do. I want to know what your plan is, because an advisor, if you're an advisor, let's think this through. Okay. What are you helping people do? Okay. And when, a recent study was conducted, and I found this very interesting, that they went to all the people who are in our financial service space. Okay. Now this could be broker dealers, it could be money managers, it could be insurance people, everybody in the financial service industry space. And they asked them, they said, if I had just met you today, okay, Ken, if I just met you today, real quickly, tell me, what do you do? Okay. And 95% of the people in our world identify themselves as asset gatherers. Okay. I'm an asset gatherer. I manage people's money and help them, grow their assets and whatever. But only 5% of those people that are in this world that we're in will come right out and say, hey, I'm a life insurance agent. Interesting, isn't it? It seems like when I first got into the business, I was a life insurance agent, okay? And that's where many of us grew up and saying, then we got the financial planning and then we're advisors. So, our world has changed and the perception of what we do has changed. But you go back to the basics. If I were to say to you, I'm a life insurance agent, what does that mean to the customer, okay? And to them, it gets right to the point, doesn't it? I help you manage the risk. And when I talk about life insurance, I'm talking about managing the risk of dying too soon or becoming sick or hurt. But the interesting thing was that after they surveyed these people, they went deeper and said, okay, where's your money coming from? How do you earn your income? What's the longevity of you in this business? And talk about the persistency that you have with your customers. So let's just kind of put this in a way that you can understand. If you want to have a greater longevity in the business, okay, life insurance is where you want to be, that life insurance agent. If you want to make more money, interesting. They make more money than their counterparts who are in the asset gathering business. And here's the interesting thing they found. If you want to have more assets under management, be identified as a life insurance agent than a person who's in that business, okay? So I found that kind of interesting. And they have longer term relationships, so the persistency with their customers is longer. So is there a downside for being a life insurance agent? Well, it doesn't sound fancy. It's really not exciting. It doesn't have a lot of pizzazz, granted. But the bottom line is you're doing the right thing for your customer. You're out there and you're not competing. What I do is I show people two different swimming pools. One swimming pool has 1 million people in it. You can barely you can barely move anywhere. And another one is like a really nice resort, has a walk-up bar, or swim-up bar, whatever they call them. And they, there's hardly two or three people in the pool. And you say, well, what pool do you want to swim in? We're both in the same world, okay? We're all in that same world. But I don't want the competition. If 95% of the advisors today are out there talking about asset management, why don't you go in there and change the rules? Say, listen, I want to help you manage the risk of dying too soon or the risk of becoming sick or hurt. Are those important to you? And then ask the question, if you became sick or hurt tomorrow, I want to know what's going to happen. Tell me what's going to happen. Do you think is it fair enough for you to know what's going to happen? Let's talk about your family. Are they ready for this? Okay. You planned, you planned a lot of things. You plan your vacations, but this is a risk that really is real. Okay. And so let's help understand what we can do for you. Okay. Let's talk about what key features are in a traditional disability income policy. And I will tell you this, and speaking for the industry, we are in a really good space, okay? Our industry as a whole is really good. And you'd say, well, who's your competition? Well, for me, my competition is life insurance, annuities, 401ks, investments. Those are my competition because I'm trying to get advisors to think in terms of having that conversation with their customers. But in our space, there's really not a bad choice. The companies that we represent in our industry and that we have available to us, we're very fortunate and very blessed to have companies that are truly committed to the industry. When I first started in the business, there were well over 400 companies manufacturing the disability income product, a form of a disability income product. Today, there's less than 30. So what does that tell you? I think the ones that are still here today, who have still maintained their presence in the marketplace, if you were to represent any one of those companies, you're not making a mistake. Okay, so that's a really good feeling as far as the industry is concerned. Okay, but these contracts stay with your customers. These are owned by your customers. They own it. They have something that's unique to them. It's personally owned. Can't be canceled. It's with the term non-cancelable, guaranteed renewable is what we're finding the predominant product in the marketplace today, meaning that, Linda, once I issue a policy to you at your age of 34, right? Maybe 35, right, Linda? Yeah. That policy will stay with you. The premiums, assuming you make no changes, will be guaranteed to age 65. That premium will stay the same. The benefits will never be reduced, modified, or changed. Any discounts you have will be permanent and portable. So this is the beauty of the product, okay? That is something that I can continually to maintain. All I have to do is do one thing, and that's what? Pay the premium. Not a bad deal, Okay, so it's a unilateral contract, as opposed to maybe a group product where you have a benefit at work, which is great. It's a nice foundation. But if you leave that employer, what do? You leave that behind, right? And so we want the individual policy is something that can meet the client's needs financially, both for benefits and features. It's not a plan in the box. So there's a lot of unique things about an individual disability income product that can stay with your customer, a young individual who's got great economic potential today, who's healthy, who wants to buy a product, good time to buy it, because they'll never be able to get this product any cheaper than they can today, because as they get older, it's going to get more expensive, things will change. So this is the type of stuff that has to be considered when you're dealing with, in particular, younger people. You know, they say, you know, most younger people, they're never going to get sick or hurt. Nothing's going to ever happen. You know, and here's the question or the comment they normally say is, well, you know, if something happens, I can move back in with my parents. Well, I'm saying, well, let's talk to those people. Let's get them on the phone, okay? Let's call mom and dad and see how well they're going to be receptive to this, okay? And then when you get the busy signal and the, you know, the voicemails and never get the return call, then it's maybe time to rethink your strategy, okay? And so that's not, I don't think that's a great strategy, but why is it important? You know, like I said, I've been doing this a long time, and when you look at what is income to you and your family, it's the foundation of everything you do. You know, a lot of people that are listening today are in that 401k space, right? And helping people, having those conversations about their 401k. First of all, let me back up a little bit. We're not talking about people who are in their, you know, late 50s or early 60s, by the way. Our customers are in the 20s, 30s, 40s, and maybe early 50s, okay? So kind of let's frame our conversation around who are the right people that we're talking to, okay? When a person's in their late 50s, early 60s, I don't know, we don't do a lot with them, but you know, the people in their 30s and 40s, this is important. And so what do you want to do is say, okay, what does your paycheck represent? Let's sit down and take the paycheck out of the picture, and let's talk about, well, what's going to happen if you do become sick or hurt? What is your plan? And what does your paycheck represent to you? Okay, is it the home you live in? Yes. The car you drive? Yes. The neighborhood you live in? The school you send your children to? The clothes you wear? The food you eat? The lifestyle you enjoy? All the things that you do, and all the things, I don't want to say it defines you, but it defines you financially and economically, okay? It defines where you live, how you live, why you live, and all the things you do. So is income important to your customer? I think it is. Because what has to happen before you can put money into a 401k? You have to have a what? You got to have a paycheck, right? What do you have to have if you want to save money for your children's education? What do you have to have? You have to have a paycheck. What if you want to buy a new car or move to a bigger home? What do you have to have? A paycheck. What if you want to go on vacation? What if you want to have money available for you like every few weeks or every few months when you want to go out and celebrate your children's birthdays or graduations or weddings, or, you know, think of all the little things. And let's talk about one big expense we have and we never think about: technology today, okay? You know, when I grew up, technology was, hey, if the light switch worked, we're good, you know, and I'm not a technology person, as you guys well know, you know. I'm just sitting here watching them hook all this stuff up. But I mean, I'll give you an example. You know, my youngest one asked me if I had Snapchat, and first thing I thought was a disease of the 70s, and I'm going, well, this is why would you ask me that question? That's kind of personal. And he goes, oh, just forget it, Dad. I'll send you a, you know, I'll mail you. And I go, cool. But it's something I really have. I'm trying to get my hands across, okay, or control it. But that's okay. But today, you know, you think about it, help people just take a minute, take a second, and say, how important is your paycheck? And would your world change if we took it away from you? Okay, is there something going to happen that you don't want to happen? And I think that's what we have to do, is help people have that conversation. It's not that people don't want to have a talk about this. Here's another study that was recently done. They went to consumers. Okay, these are the people, the buying consumer, and they asked them, well, first of all, what they did is they said, okay, here's what income replacement does. Let me tell you what it does. Okay, and here's how it works. Okay, and then they asked them, knowing what you know right now in the first, you know, in the 3 minutes that we talked about what income replacement is, would you buy this? And you know what? 60% of those people said, yeah, I can see the importance. This is important. I see this, okay? And then what they did is they went to advisors, people like you and I in the marketplace. And they said, okay, let me explain to you what income replacement is. Okay, it took 2 or 3 minutes to kind of talk about that. And they said, would you sell this? And they go, yeah, this sounds important. Why don't you sell it? Is the next question. You know what the answer came back? They found out that advisors said, well, my customer never really asked me about this. Okay, well, that's kind of sad. Okay, because I mean, if you're sitting back, I don't know, Keith, I know you've been through a lot of training. You're involved in training. You ever sit back and say, okay, guys, we're going to have a class on how to wait for the phone call to get somebody to buy something. I mean, you'd be sitting in there forever, right? And what they found was 60% of consumers said they were, yeah, I would buy this. Okay, but then you had 60% of advisors saying, you know what, if my customer were to ask, I would sell this. Now, I'm thinking back, and I'm thinking, well, that's interesting. We have an equal number of people who are willing to buy something versus an equal number of people who are willing to sell something. And so I'm thinking, it brings me back to the days when my kids went to junior high dances. Okay, how many of you been to a junior high dance lately? But you have the girls on the left and the boys on the right, right? And then nothing happens until they turn the lights off and the music starts, okay? And then you just kind of want to back away and just kind of rub your eyes and say, boy, that was weird. But I'm just saying, take your customer to the dance. You know what? They're willing to, 60% of them are willing to say, yes, I want to buy this, but 60% of us are not willing to have that conversation. They're waiting for that customer to say, hey, tell me about this. So here's, let's be the adult in the room and say, hey, listen, Mr. Customer, Mrs. Customer, if you became sick or hurt tomorrow, what's your plan? What are you going to do? Is your income important to you? And what does your income do for you today? And in the absence of your income, what are you willing to give up? It's not what are you going to give up? What are you willing to give up? Because you're an adult. These are all the things that you know, it's important. Your income's important. So what are you willing to give up? Okay. So let's take a look at this. This pyramid has been around forever. I think, I don't know, Moses made it or somebody, but it's been around forever. But but it's true. It's been, and it's a proven thing that people can look at and say, you know what? I've got property insurance, health insurance, life insurance, and car insurance, all good. And then as my career goes, as I'm working hard, what I do is I build my retirement and personal investments. I do some savings. I may even buy a business, okay? And then as I get older and I'm starting to transition maybe into retirement, I want to pass those assets on to my partners, my family, to charity, okay, whomever. But the one thing that has to happen here is what? What's the most important thing that makes all this work? What is buying the home? What's used to buy the health insurance? What are you buying the life insurance? What are you buying the cars with? Okay, or how are you creating a retirement nest egg? Because there's one thing that has to happen each and every day for your customer. They have to get up and do what? Go to work, and they have to get a paycheck. Bottom line, okay? You take that out of the equation, then does any of this really matter? It really doesn't. No, it does not matter. If they can just say, oh yeah, I can, do this, do that. No, you can't. No, because what we find out is the people who are on claim, they worry about two things. Number one, how to manage the pain, okay, and staying alive. Legitimate disabled people, those are the things that they really, really focus on. You want them to worry about, well, how am I going to keep my family in the home? How am I going to be able to afford my car insurance, let alone my health insurance? What about retirement and savings accounts? Okay. Well, how am I going to do? Those things make life really, really stressful for your customer. Okay. In the absence of not having it. Okay. Another unexpected. 1 in 4 of us today, 20-year-olds, people getting out of college. Okay. Think in terms of this. 1 in 4 of those people will become sick or hurt and lose their income for an extended period of time. Okay. Every 7 seconds, a working age American suffers a disabling injury. Over 53 million American adults live with a disability. I mean, this is kind of concerning, is it not? I mean, when you take a look at, I want you all today to go out and I want you to look at, as you leave the building you're in, look at the door handles. Look at the way that the entryway to the building is created. It's like it's no longer steps out there, right? Take a look at how many handicap parking spaces are outside your building. okay? Take a look at all the different things as a result of something that happened well over 25 years ago with the Americans with Disabilities Act, okay? Why was that such far-reaching? Why was that so important? Because it affected so many people, okay? And unless you're one of those people, you don't understand and you don't really appreciate what that did for a very large segment of our economy, okay? Because these people still are they still go to the grocery store, they still go to the restaurants, they still do all these things, okay? But it's important to understand, yeah, there are a lot of people who are sick or hurt, not able to maintain, you know, to you, they may seem fine, but they're lacking one thing. What is it? They're not getting what? They're not getting a paycheck, okay? So it's important to understand, yeah, it could happen, okay? So common misconceptions, and there are a lot of misconceptions. You know, we get it all the time. I mean, there are things that we hear that go, I can't believe they said that, but it won't happen to me. I'm pretty active and expect to stay healthy. Well, of course you are, okay? And you know, when you think that, and we'll show you this, a lot of people, when they think of a disability or becoming sick or hurt, what's the first thing that comes to mind? How is it going to happen to me? What's the first thing? Most people think, well, it's going to be an accident, right? I'm going to fall out of a tree. I'm going to be up roofing my house and fall off the roof. I'm going to get in a car accident. I'm going to have a bus hit me. I mean, there's all these things. People think in terms of accidents, okay? And in our world, and globally in our industry, fewer than 10% of disabilities that we pay are related in any way to an accident. So you got well over 90%. I know with our company, we're at 96% are sickness related. Only 4% are accidents, okay? So what does it tell you, okay? The people clearly don't understand how this could happen. Cancer, heart disease, mental nervous, alcohol and drug abuse. And we'll show you what some of the statistics are. But you know what? There's people just don't clearly understand this, okay? And this, as an advisor, what is your role as an advisor? Is to help advise, right? And help them understand this could happen, okay? I mean, you all know, you know, basis points and BIPs and all these different things, these terms used in money management, okay? But, you know, just sit in front of your customer and say, listen, if you become disabled, there's a 1 in 4 chance that you as a young person is going to be sick or hurt. And that the average duration is going to be around 31 months. So just ask them, say, you know, first thing first, did you plan for your 31-month vacation? Okay. What are you talking about? Just have them start talking about it. You know, because if you're working with a reasonable person who is intelligent, responsible, has good economic potential, they're going to understand that there's a lot to lose if they lose their paycheck, okay? Disability insurance isn't something I can afford. Well, you know, the old school is, well, you can't afford not to have it. But you know, the unique thing about income replacement, like I said, it's not a plan in the box, but you got to help them find the money. Okay, help them find the way to pay for this. And when dealing with younger people, I'll tell you an example. My son started, he's an architect in Chicago, called me up, said, hey, let's go over the benefits, you know, blah, 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 blah. And he said, Dad, I get 4% of my money. I can get this match, you know, for the 401k. And I said, okay, tell me what that means to you. He goes, well, I'm getting, you know, 100% of my money back or whatever. And he started, I said, well, what if you got sick or hurt? Tell me what's going to happen. He goes, well, I gotta have group insurance. I said, well, is it enough? Let's do the numbers. Okay, let's just really, you pencil it out. Let's talk about it. If you become sick or hurt, I said, do you see something missing here? And he said, yeah, I won't have enough to be able to afford to live in Chicago if I become sick or hurt, you know, better alone be able to afford to live in Chicago working, you know, because it's expensive. But I said, well, you know what, if instead of putting 4% into your retirement plan, your 401k, why don't you give me 2% of it? Just give me better, in fact, just give me 1% of it, and I'll be able to fill that gap for you. And then next year, as you get your 4%, 3% raise, then you take that other 2% and you fill up the 401k again. Okay, but for now, I don't think you don't have the permission to go put all that money into your 401k yet. You got to take care of yourself and make sure that your income is going to be maintained if you do become sick, because you have obligations. You got a car payment, you got transportation costs, you've got, you know, your internet and all this, all the other stuff that you enjoy. You know, you got your rent and things like that. So I said, let's just put things in perspective. What's important right now, and what's the thing that you know you can protect today, and then down the road, a year from now, how big an effect will that have on your 401k? Not a big effect, but I will tell you this much: if you lose your income, that will have a major effect on your retirement. okay? So let's protect what's important, okay? In many cases, you can own a policy for as little as whatever you want. You could always grow that policy. The only thing that has to stay intact is what? Your health, right? But a lot of carriers today offer these income options where you can buy future coverage and not have to worry about it, insurability. So get in the game, buy it, get in the game, be an owner at whatever cost, if it's $100 a month or $50 a month or whatever you can afford. I already have coverage through my employer and or the government. This is the most common one we get. Hey, I work, I have a job, I get 60% of my income covered. Great. Tell me about it. How does it work? And guess what the client's going to say? I have no idea. Okay. I have no idea. Well, don't you think it's probably wise to find out? Okay. You know, a lot of times, life insurance, if you're selling life insurance, okay, and you ask the customer, I said, how much life insurance do you own? I don't know. So here's what you do. You got two choices to find out, right? You can find out right now where we do an inventory of the life insurance you own. Is it going to be adequate? Or better yet, why don't you die and I'll let you know what happened? Okay. Typically not a good strategy. Okay. What are you going to have for retirement? I don't know. I'm just going to throw a bunch of money in there and hope it works. Okay. No, that's not how it works, right? So the same thing with income replacement. Let's talk about, and we'll talk about a little bit more about that too, but it's important to understand. Here's the statistics, and we say that it plays no favorites. When you look at mental nervous claims and muscular and skeletal claims, I mean, they happen, okay? I remember in March of 2014, I'll give you a personal experience of my own. I had gotten up in the morning, real early, 2 o'clock in the morning, with the worst headache I ever had in my life, and it was just devastating. I mean, I've never had a headache like this before. The other headaches, they all moved out and went to college and they grew up, but this headache was serious, okay? And so I woke my wife up. I said, I can't deal with this. So we went to the hospital, and the next thing I know, I wake up in the morning and I'm in a hospital room, okay? And my wife's with me and a neurologist, or I think it's a neurologist, comes in. He says, well, what we think you have, we got to do a couple more tests. We think you have meningitis. And I'm saying, well, okay, don't I no clue what that is, but tell me more. And he said, well, this could end one of three ways. He says, and he was kind of blunt. I mean, he was right to the point. First thing he says is, you may not recover from this. Matter of fact, it's fatal. Well, you got drawer number 2. And then he goes, well, the second option thing that could happen is you could recover, but you'll probably never be able to work again. You just won't be able to work. You're just not going to be able to, have your wherewithal. And then the third thing is you're going to walk out of here, have a time for recovery, and you'll be fine and go right back to work. Okay. So I'm thinking, wow, that's pretty. And then he walked away, and I'm going, that's kind of crazy. So my wife is sitting there with me, and she goes, wow, it's like we're looking at each other, and I said, okay, here, let's just talk about really what happened here. Okay. Let's talk about the 3 options. If I die, guess what? Remember how we're worked on? We do our planning every year and all the life insurance and all the stuff I have. Yeah. Well, that's why we did this. Okay. That's why we have the life insurance for this situation right here. So you know what we able to check? Don't have to talk about it. And what else do we not have to do? Don't have to worry about it. Okay. The second thing, well, what if I not be able to work? Okay, let's talk about this. Our planning, I've got this, I've got that, I've got this disability policy, and I'm fortunate I have a lot of disability. I've got retirement plan, disability from my retirement plan, all this stuff. So I said, if I were not to be able to work, financially, we're not going to miss a beat. Okay, we're still going to be able to live our lifestyle. Check. Okay, and so what do we want to focus on? When I was sitting there with her, what became important for us that we didn't have to worry about, didn't have to stress about? Because you know what? Option A and B, we don't want that to happen, but it won't affect her. Everything's fine. So what could we focus on? Becoming healthy, okay? Staying alive, becoming healthy. Can you imagine? I was sitting there thinking, if I were this guy and I just got this word and I had no income replacement, I had inadequate amount of life insurance, you know how stressed out I'd be? That would be the worst thing. I couldn't imagine living in that world, okay? And so this is what we want to help people do. This is this is why we do what we do, okay? Is we have adequate amount of life insurance and we have adequate amount of income replacement. Why? Because your customers are going to be in that situation, okay? and they're going to be faced with the reality of life and death and disability, and they want to be able to answer those questions like I did. And that's what my goal is for every customer. Every customer of yours, every customer that I see of yours, that's my goal. Make sure that when they become sick or hurt, we have the most amount of money for them at the time they need it most. I don't care how they get it, just so they have it, okay? And so it could happen to them, okay? Expenses increase, and this is a great precedent. People, you know, let's just draw this out. You're making X amount of dollars of income today, okay? And you have a little bit of savings, we hope, and below that is your expenses. When you become sick or hurt, your world's going to turn upside down. Your expenses are going to go up. Your income's going to go down. And what are you going to create for you and your family? What do you let? What, you know, this is all right here. This is what your family gets. Is that what you want to leave them? Okay. And you know, if you got a guy or gal who says, you know, I really don't care. Well, is that a good customer? No. Okay. But for the most part, your customers don't want to create debt for their family. And so this is what income replacement does. Okay. It really does. It's a miracle product. Okay. Let's see here. So what do they have at stake? What do they have to lose, okay, by not taking your advice? Well, you know, a lot of people when they take economics courses, right, the first thing they talk about is risk and risk management, and then they also talk about how do you manage risk, okay? Well, you can defer, or you could delay, you can avoid risk, okay? What else can you do with risk? You can avoid it. You can reduce it. You can, or you can transfer it, okay? Well, let's transfer the risk of death and disability, okay? To whom? To the people who manage it the best. Who are those? Insurance companies, right? So what do you have to lose? Your future earnings. Is that a problem if you lost your future earnings? Your retirement, standard of living, your future insurability. Are any of these things important to you and your family? If they are, then we have to have a conversation on talking about this. You know, what we try to do, and we hope that advisors get to the point where they're having the conversation about income replacement. They're talking about it, and they're talking about the solution in the absence of having a proposal. If you can do this without a proposal, because a lot of times we see this, we get the proposal, that's the first thing we put out. You know, how many of you been to a restaurant before? And you're sitting at the restaurant, and the waiter or waitress brings you the food. Boom, they bring you food, okay? Then after you eat, they go, would you like a menu? No. Okay. So let's talk about what you want, what you feel, why would you do this? What would be best for you? Okay. If you were to create your own plan, knowing the parameters we have in our industry, how would you develop a plan? What amount would you need? You know, we always show them what? Well, if they make 100,000, let's show them the most they can buy. Okay. Well, that's fine. You know, you always should do that. You got to be prudent, show that amount of money. But why don't you talk about it? Hey, let's just talk about what is at risk. Okay. If you became sick or hurt tomorrow and I became your banker and I'm going to write you a check every month, how big of a check do you want? How big of a check do you want me to give you? Okay. And let's talk about it. Okay. Income protection is one way your clients can better prepare for life's twists and turns, because you know they're going to happen. I can tell you it happened to me. Never thought it was. How does it work? If you can't earn an income, injury or sickness, we're going to cover your paycheck. It's really not hard. This income replacement is not difficult to understand, you know. And when we look at how it works, it's pretty easy. Pay the money to the insurance company and we're on our way. So let's take a look at, you know, we visit with customers, and we've done some research on this too. It's not like we're making this up. There's only really 5 things they want to know, okay? The 5 things that your customer wants to know are this. How long do I wait to get my money? And what term do we call that? Elimination period, waiting period, right? So how long do I have to wait before I get my money? Second thing is, if I get my money, how long are you going to pay me? And that's going to be defined as what? The benefit period, right? So the benefit period is age 65, 5 years, age 70, age 60, whatever. Okay, so you got how long do I have to wait to get the money? How long will you give me the money? The third question is, how much money will you give me? That's the benefit amount. I'm going to give you $4,250 or $12,785, whatever that number. It's that number based on the total disability. The fourth thing they want to know is, okay, I know I have to wait 90 days. I know you're going to pay me to age 65. I know you're going to pay me $5,000 a month, but what do I have to do to get the money? And that's what? That's your definition of disability. Got to be what? Under the care of a doctor as a result of a sickness or injury, right? that results in your inability to do one or more of the important duties of your regular occupation, or you suffer a loss of income. I mean, make it easy for people to understand. Like I told you before when I first started, if I can understand it, they can understand it. I am not a brain surgeon, okay? I am not a rocket scientist. I just try to make things simple, okay? That's the way I am. If I can understand it, and I can understand it with conviction, compassion, and empathy, and enthusiasm, then they'll understand it, okay? So what's the last thing they want to know? We know, hey, you got to wait 90 days. We're going to pay you to age 65. We're going to pay you $5,000 a month. We're going to, you can't do what you were doing, so on and so forth. What's the last thing they want to know? What's it going to cost me, right, kids? Hey, what's all this going to cost me? It's going to cost you $75.85 a month. Is it worth it? Yeah, absolutely. Are you willing to invest that little amount of money into this? Absolutely. Let's start the paperwork. Okay, let's get this thing going. Because why? Because this is the thing that I found is really, really, one phrase that I think is important when you're talking about closing is to look at your customer in the eye and say, you know what? This is important. This is important. How many of you would, let's go through your mind thought, okay? What would go through your mind if your attorney called you in the middle of the day and said, Linda, we got to talk because this is important, right? Well, what would you, but you know what we would do? We would stop everything. I'm going down to the attorney's office. I got to find out what's going on. Worse yet, your cardiologist calls you. Okay, he calls you and says, Keith, I got to talk. I got to see you today because this is important. What? Like, wait a minute. Stop everything. I'm going down, right? Why can't you guys take the same approach? You're equally as important. Matter of fact, I think you're more important to those people because you can do things for those people that they can't. You can create large amounts of wealth for them tomorrow. Their wife can get a check for $1 million. They can't make you're the only one that can do that, okay? You can't create income. They're not going to give your customers a steady, guaranteed stream of income. They're not going to pay your health care benefits. They're not going to cover your retirement. You do that. We're important people, okay? And we are a very important part of our economy, the most important part of our economy, okay? So if you called your customer and said, Ken, we got to talk because this is important. I think it's important, don't you think? This is important stuff. In the absence of not having that conversation, then something happens. Who are they going to call? They're calling who? They're not calling their attorney. They're not calling their cardiologist. Who are they calling if they want the money? They're calling you. Got to have an answer. You got to have an answer. So these are the things that make it simple. Occupation, class, really, that company to company, and that defines, basically, what it defines is where do they fall based on, experience with the company, claims history, risk, and that's what the risk classification. The better risk that you are, the lower the premium you have, okay? The higher risk, the higher the premium you have. So those are the things that kind of keep in mind. So when we talk about what most people, and this is the biggest objection we see here, okay, is people say to us that I have benefits at work. Well, terrific. Tell me what they mean to you. Tell me what it means to you to become sick or hurt relying on your employee benefits, okay? And what this shows you here is you've got a person making $60,000 a year or $5,000 a month, right? And after everything is said and done, they're bringing home about $3,500. And now remember, what is that $3,500? That's the home they live in, the car they drive, the school where they send their children to. What does that define? That defines who they are, right? They become sick or hurt, they're getting 60% of the 5, okay? And then that, because the employer most generally will pay the premium, now they're down to $2,100. What's going to change in their world? Now, granted, they've got $2,100 a month coming in, but what do they have to give up? They want to give up the cars, the kids at school, okay? See, they have choices. Now, without the choice, without buying anything here, they don't have a lot of choices, okay? But what you can do is help them supplement that, get them back up to pretty close to where they are. But keep in mind that your employees, the people you work with, they have to go through 4 doors. And people don't understand the financial consequence associated with becoming sick or hurt. So imagine you're one of the employees of this company and you're sick or hurt and you're going into the office and you're talking to the people who manage your benefits. The first one's going to be the long-term disability income door, okay? And this is what it's going to look like. Hey, we're going to pay you 60%. You're going to file that for income tax. Your income's going to go to $2,100. Boom, door number 1. What's the second door they go through? Second door says, okay, we've been paying a good portion of your medical health care coverage. Okay, that's going to change. Now you have to pay, based on COBRA, you're going to have to pay your health care coverage for you and your family. And I'm thinking that's pretty cheap stuff today. Okay, you know, like $50 a month, something like that. Not, it's expensive. Okay, so now your income dropped by 40%, and you're picking up a pretty substantial expense in your health care. Okay, what's the third door the house that person has to go through? There's a third door. The third door is the person who handles their 401k. Okay, and the 401k person says, hey, thank you for putting your money in. You got a couple choices. You could leave your money here, or you can transfer it out. You can roll it over, do whatever you want. But here's the one thing they're going to tell you: we're not going to put any more money into a 401k. But here's the surprising thing: the vast majority of people who are participants in a 401k, they honestly believe that their employer is going to continue to make those contributions. And I'm thinking, where'd they get that information? Okay, because what is a 401k? It's a function of what? You got to have one thing first: earned income, right? And you take earned income out of the equation. I don't know. I grew up on a little, you know, on the south side of Des Moines over here. Went to a great Catholic school, but I think, you know, 100% of zero is zero, right? Even 50% of zero it's zero. Any way you cut it, it's nothing, right? And so again, I'm not a rocket scientist, but that I know nothing's going to happen, nothing good's going to happen. So you got your income fell by 40%. Your expenses went up by your healthcare cost, and who knows what that's going to be. Third thing is what? You know, your 401k is frozen in time. Now, what's the fourth door they have to go through? This one here is the toughest. They have to go home to their family, open the front door, and say, hey, I got some good news and I got some bad news. You're going to see a lot of me, but I'm not able to work, and the health care and all these things that are going to occur. So it's what you want to do is help those customers understand that they're going to have this conversation. Are they financially prepared for this? Okay, because when you look at the probability of death versus disability during your working years, the likelihood of disability is like 7 times greater. Okay, but we all have life insurance, which, God love you, I'm a big fan of life insurance, but think this through here, folks. Okay, what's the real big problem that's going to occur between now and the time your customer dies? Okay, you look at, you know, the hospice care. You look at the hospitals. You compare the number of hospital beds in your community versus the funeral homes. I mean, there's a disproportionate amount. Why? Okay, tomorrow could be the last day that you can legitimately earn a paycheck. Okay, and so it's important that you clearly understand what is the consequence of just relying. And you know what? I can probably honestly say this with a great deal of confidence, that 90% of your customers who own this or who have this benefit have no idea how it works. They don't know what it covers. They don't know what it will do. They don't know everything. They don't know this, okay? And what's the worst thing? And I always say this, you know, it's what we don't know that's really the big problem for people. It's what we don't know that's really the big problem. So help them understand. What about some examples? Okay. And then, okay. Susan, investment advisor, looking to enhance her benefit package to recruit and retain high-performing employees. To do that, she wanted to offer a comprehensive benefit package to her people who could build wealth and protect their income. Great. We talked to her financial professional who's a member of her Bible study group, and they laid out a plan solution. They offered voluntary MultiLife disability income coverage. 18 employees were eligible and took advantage of it. Those individuals saved $3,950 annually because of the 20% MultiLife discount. I mean, remember, it's important what we sell a customer, but if we can find ways to sell it and make it more affordable and more attractive for them, these MultiLife discounts that are in the marketplace today are pretty darn good. They're pretty cool, okay? They're a great way. And you know, I'll be honest with you, the discounting of premium is not intended to really discount the premium for your customer. You know, if you really look back, why do companies offer these MultiLife discounts? It's for you as an advisor to be able to go into a given demographic, whether it be an employer, an association, or whatever, and be able to offer a competitive product, okay, at a price discount that you have, that you can give them, okay? Because people like to buy based on price discounts and ease of being able to implement the plan. And that's what MultiLife does for you. So that's a great marketing tool, okay? The other thing, here's another example. Personally, John, he just left a large practice with robust benefits to start his own practice. He has now looking to protect protection options as financial advisor, and made sure to discuss the importance of risk protection, life insurance, and disability. Smart advisor, right? Very smart advice. Help prepare for the unexpected. To drive home the need for disability income, they've leveraged the policy highlights and also talked to their local rep for tips, solution clients versus both disability income and term life insurance. You know, if you have a person who understands the value of life insurance, you know, you ask them, why do you buy life insurance? Why do you own life insurance? Well, if I became disabled, if I died, what do they want to do? They want to replace my financial impact on the family. And that could be by income, right? I want to replace my income. Well, what if you survive the stroke? Okay. What if that cancer is long-term? Okay. What if it takes you 3 years before you die? Okay. Or what if you survive the car accident? I mean, what if? The what ifs, okay? You have to have those conversations with your customers, okay? Or what if the sickness or injury, or what if you get something that's devastating, or, you know, Parkinson's disease? You know, we saw that at the state convention this year, you know, with Troy, has Parkinson's. And you know what? It's gradually it's not going to get better, right? Okay. And so things happen. And Troy's a vibrant young man, right? So, I mean, it happens. And so, and he, you know, he's not immune from it just because he was an insurance professional. It can happen to any of us, okay? So it's important to help the clients understand, boy, there's a lot at risk here for saving pennies to the dollar. Income protection for key employees. This is our next hour, so we can take a break right now, or Keith, we'll turn it over to you. And
Thank you, Rick. Before we take a break, I'm going to turn it back over to Brian in Falls Church with another polling question. Brian?
Thank you, Keith. And now for another polling question for our virtual viewers. What state are you viewing this program from? What state are you viewing this program from? Please use the polling function on your screen to respond. You have 2 minutes. We will now take a 10-minute program break, and we will resume at 10:20 a.m. sharp.
The answer is Iowa. Is it Iowa? Did I get it right? Des Moines? I'm like, hour till tournament time.
I know.
NCAA starts.
oh, it's got glasses off. Well, it's not a good sign, Keith.
No, this is my next thing.
Oh,
I don't need glasses to see that.
oh no, you don't.
I just want to make sure it's there. All right, I'm back.
You're back. Hey, what's going on?
Here.
and start your video. Let's video started. So the next polling question for our virtual viewers is, what is your primary practice specialty? What is your primary practice specialty? Please use the polling function on your screen to respond. You will have 2 minutes. And now back to Rick to continue the program.
Polling question there. Solutions for key employees. Now, what I want to do here is I want to frame this conversation. You know, a lot of us are in that employee benefit arena, and we talk about healthcare. We're talking about maybe group long-term disability, group life, dental, vision, things like this. What I want to do is kind of focus our attention not on the total mass of people. Okay, what I want this to be is more of a conversation on the executives of the company. Okay, the top earners, the top tier, the C class, and in doing so, what we want to do is kind of focus our attention on the higher income people, not everybody. So we're talking about executive benefits here, okay, and executive solutions. And one of the things that we want to do is, knowing that we're going to be dealing with 2 to 3 to 5 to 10 people within this class, is kind of give you an idea or clearly understand that as the number of individuals in a given group increases, you know, the chances and the probability of a disability of one of those individuals becoming sick or hurt grows exponentially. So as an example, if you're working with a group of 40-year-olds, okay, and you have 5 of those individuals within the group, okay, that you're talking to, you know, there's a really good chance, and basically the numbers show you that there's a 95% chance that one of those 5 individuals is not going to continue to work through to retirement, okay? And so that's kind of important to understand. So this kind of gives you an idea that when you're dealing with a group up to 6 maybe, you know, the numbers get pretty high. I mean, I don't know if a 30-year-old, you know, there's a 99% chance, okay? And so the probability is very, very good that these individuals that you're dealing with in a larger group, when I talk about a larger executive group, that the probability of one of those individuals becoming sick or hurt for an extended period of time is pretty high, okay? Now, that being said, let's identify what the opportunities are. You know, and when you're looking at today's economy, you know, and I'm not an economist, but I hear people and I pay attention to what's going on around me, is that maybe 10 years ago, say 7 years ago, there may have been a little over 5 individuals vying for one position, one executive position, okay? Today, with the unemployment rate relatively low, at a record low, that when you look at the number of individuals vying for a position, it's less than 1, okay? So when you look at that, what employers need to do is say, hey, I need to find a way to enrich and to enhance our benefit package, okay, to create an environment and create an opportunity for an individual who's in the workplace or who currently is a key executive of mine to stay. And I want to be able to recruit, I want to reward, and I want to retain these employees. And it's very, very critical in today's world today, because there are so many opportunities for individuals to go from company A to company B, okay? For key employees, protecting their income and ability to save for retirement, even if they don't work, due to an illness or injury as key factors. And so what we're going to be doing is talking about two fundamental concepts here. We're going to be talking about protecting their income. And remember when we first started, what they buy is important, but how they buy it or how you sell it is equally as important, okay? So what we do is try to show you a couple things. The first one is what's called salary continuation program. Now this program may come up with different words. It could be qualified sick pay plan, salary continuation. I mean, there's a lot of different ways we in the marketplace that we talk about this. And so this is a very fundamental approach to protecting income, okay? And did I slide? Okay. Let's do this one here. I'm frozen. Okay. Hold on a second. With a salary continuation program, what makes them rather unique is, yep, perfect. If you want to just wage continuation, yeah, a formal. Can we go further? Okay, let's see if it works. Perfect. Okay, excellent. Thank you. Thank you very much, Lex. With this plan, this is a formal plan. It's a qualified plan. There are things that your customer has to do in order to make this work. And I will be honest with you, within the marketplace today, the one product solution that best fits this type of requirement, where we find most of your employers do this already, is with a group long-term disability income plan, okay? It's a formal plan that describes in writing how the employee will continue to get paid for all or part of the employees if they become disabled, covers an entire class of employees, does not allow for selectivity within the class, commonly funded with individual and or group insurance, and it's ideal for C corporations because the owners can be covered under this. But what it is, traditionally, the LTD plan is typically a great solution for this because it covers the masses. And I'll be honest with you, I think when you look at group long-term disability income, there has been a trend, okay, within the group market, maybe to make it less rich than it was before. You know, years ago, we used to find 70% plans. We used to find 67% replacement plans with very high caps and maximums. Today, you're seeing a lot of employers reduce that from 67 to 60%, going from 20,000 to 15 or to 10 or to 5. And we're seeing some changes in the marketplace and the dynamics of what's been happening, not so much because they want to, because the cause and effect of healthcare today, okay? Because healthcare covers and takes up the majority of the employee benefit dollar, okay? So today, when they look at this, when you're looking at all the things that are driving, you know, costs today in healthcare and employee benefits, LTD, we've seen some reduction in those. So we think it's an excellent opportunity for you to go in there and talk about supplementing that. Yes?
It says all or part of an employee's salary. Can you have 100%? I mean, I know it would be expensive.
Well, you know, under a wage continuation plan, you can have a plan that says, Ken, if you become disabled, we're going to pay 100% of your income for 6 months or 9 months or 2 years. I mean, it doesn't define that. I mean, if the employer wants to do that, they can. And that's typically what you'll find in a qualified sick. That covers a lot of different things, qualified sick pay plans. To make it qualified, it has to be in writing, has to be communicated, all those different things that we'll talk about. But you can literally have a company that says, listen, we're going to pay you a sick pay plan or a wage continuation or whatever they want to call it, okay? Now, long term, that probably would not be a very good strategy for the company because of the FAFSA rules, they'd have to show that on the books as far as an obligation. So that's why we have insured plans, okay? This doesn't really reference being insured or non-insured. This just represents the fact that they have a plan, okay? And long-term disability, group long-term disability, and individual disability are the common ways to fund that, okay? I'll have copies of these slides for you too if you want them, all right? So now we know what a qualified sick pay plan is. Let's talk about what are the guidelines. What do they have to have? And it has to be well-defined, okay? In writing, the program must state who's covered, and that could be by class, okay, or it could be all eligible employees, salaried employees, all exempt employees. I mean, you have to do it by a defined class, how much to pay. they're going to get what are they going to get for their income? And typically with a group plan, what do you get? You get a percentage. Or we're going to pay you 60% of your covered monthly payroll and define what that is, okay? When do the payments begin, right? Waiting period, okay? And the next thing is how long will payments continue? And that will define that if you do become sick or hurt, how long will we pay you? And I think what we're finding most in the marketplace in this environment is something that's going to pay to normal Social Security, normal retirement age, okay? So what that has, they have to have that intact, okay? They have to define, you know, who is covered, how much will they pay, when the payments begin, and how long payments continue. And the important thing to keep in mind, it cannot be discriminatory. They can't pick and choose who they do this for. They have to do for all individuals in that class, okay? They can't pick and choose. What if they did pick and choose? If they did it for? What would that cause in our world?
Discrimination.
Well, it would cause adverse selection. Linda, if you have a company with 100 people, you're going to find, and you really don't want to do anything, but you could do something, okay? And there's 5 people currently diagnosed with cancer. Who would you insure? Those 5 people with cancer, okay? Right? I mean, so what it would do is it would create adverse selection by giving an individual an opportunity to pick, because we pick the risk, they don't pick the risk, okay? And so if they get to pick the risk, it throws the whole concept of insurance kind of out the window. You know what I'm saying? So it doesn't work really well. In order to gain tax advantages, and this is why companies want to do this, the program must show the intent to fulfill a promise of benefits and be supported by a written agreement communicated to all covered employees and established before a disability occurs, okay? And typically when you talk about, when they talk about a written agreement, and it could be one of two things. Within the group world, group long-term disability, they have what's called the summary plan description. How many of you have ever gone to a company, started for a company, they give you a packet of information, right? And in this information is a summary of all the plans and their descriptions of what they are. Talks about the healthcare, the dental, the long-term disability, okay, in a very easy way for a consumer to understand. It's not the full policy, but it's a summary plan description, okay? And that's the written agreement, communicated, covers all the employees, and obviously it has to be done before anybody's disabled, okay? So these are their criteria. Now, in the absence of this, can a company, they can still do this, but they don't qualify for a deduction of the premiums as a fringe benefit, okay? So you think in terms of why would they do it anyway if they can't do that? So in order to be qualified, they have to meet these criteria. That way they have the ability then to deduct that cost, you know, as a line item, as a fringe benefit, like they do their health care and other benefits, okay? And that's the whole intent of a wage continuation agreement plan, is to make it qualified where the corporation can deduct the premium as a fringe benefit. And let's go back and remember we talked about why was it important, let's see if I have it here, for a C corporation. This is important to understand. Let's say, hypothetically say, you know, that Seth, you're the owner of the company, okay? And let's look at 2 different scenarios, okay? Seth, you own the company, you have 100 employees, and you're buying an LTD benefit for them, and you're including yourself because you're an employee too. You get a W-2. If you own a C corporation, okay, meaning that let's say you're a shareholder and you own 100% of the shares. Let's just make it easy, okay? As an employee, then the premium attributed to your cost for the LTD can be deducted as a fringe benefit, okay? That's okay, because it's a C corporation. And the C corporation basically is not a pass-through entity. They can retain earnings, right? So you have the C corp, I'm a W-2 employee, I'm just like anybody else, okay? Now let's just say you're an S corporation, okay? Or a pass-through type of entity, LLC, whatever it may be, okay? But in the absence of being a C corporation, where you get the earnings from the company come back and pass through to you, okay? Under that circumstance, under no way can the company deduct the premium to you as a fringe benefit. So at the end of the year, they have to say, okay, Seth, because you own this, your accountant or CPA is going to take the premium that was been attributed to you for the cost of this and say, okay, Seth, because you have to pay the premium, so we're going to bonus you this money, okay? And we're going to give you the $1,800 that it cost, and we're going to deduct it as a as opposed to a fringe benefit on this side, we're going to deduct it as a wage expense. Okay. Now that's a good and bad. Now that creates what's called an executive bonus plan. Okay. But keep in mind, whenever you're dealing, we get this a lot of times. We get, we may get a law firm, we may get a dental practice, a small group. We've got 3 dentists or 3 lawyers, and they come back and they say, well, they have group LTD, but is it taxable? No, it's tax-free. So we have to segregate those groups whenever we do any individual disability income planning. And sometimes an advisor doesn't understand that or realize that. They assume, well, yeah, it's tax deductible because the company's writing the check. Well, the company could write the check, but what happens behind the doors is a little bit something different. And so we come to find out that these attorneys were partners. Okay, so it's a form of partnership. The benefits are tax-free, and we proposed a benefit for $5,000. Well, they can only get $3,500. Okay, this is kind of what we want to do. Is the more information you know up front, and the more information you give to those individuals who run your proposals and do your plan designs, you have to let them, especially when you're dealing with a business owner, is it a pass-through entity or is it a C corporation? Now, the vast majority of companies within our area are S corporations or pass-through entities. Why? Because in the state of Iowa, it's more advantageous to be an S corp for a small company than it is a C corp. But that may not be the case all around the country. And we know we have people from all over the world and in Europe and on the moon watching this. So it's important that y'all understand what's going on in your world. So, so kind of clearly understand, the information when you have a discussion with your customer, you got to really know what they do. And, that's usually when I'm visiting with an advisor and their customer, my first question is, tell me about your business. Okay. Who are you? What are you? And how are you structured? Because that really defines the rules. You got to understand the rules you got to live by. And that the government kind of gives you those rules to do it. So we've got who's covered, how much, when the payments begin, and it all has to be supported in written document, communicated, and established, obviously, prior to a disability. Okay? So let's take a look at the benefits. Let's talk about benefits of having a wage continuation for the business. Okay? In today's world, obviously, benefits are really, really important. So let's take a look at helps attract and retain talented people, reinforces employer-employee relations, help manage the financial risk of losing a key employee, and uses business resources for a tax-favored basis. Okay, so it's tax deductible. Let's talk about the key employee. Protects their income. That's important. And I'll be honest with you, in a large scope, when you take a look at the whole enterprise of a company, anytime that you can offer LTD benefits to that lower income, lower threshold people, the rank and file, it's very important. Why is that? Remember I told you the very first thing, my objective, very first thing whenever we meet with a customer or do any planning is to do what? Put the most amount of money in somebody's hands when they become disabled. I don't know about a lot of you, but I will say the vast majority of you do not wake up in the middle of the night or first thing in the morning and say, I want to go out and see all the rank and file people of this company. I want to see, who do I want to see? Who do I want to talk to? Who do I want a relationship with, right? I want to go out and see as many people in the mailroom in that company as I possibly can. We don't. Unfortunately, these people are disenfranchised. Most of the time, I'll be honest with you, I think these people are disenfranchised from having the service of an advisor. Anytime they can get a benefit like this, it's very important because their income is equally as important to them as the president's income or anybody else's, okay? So group long-term disability, if you can extend it to the masses, okay, that's what it's intended for. It was never intended for, from my perspective, a benefit for the highly comp professional, upper income group. It was designed to protect those individuals who most generally have been disenfranchised from the opportunity to have conversations with an advisor. Okay, this is something that they need. Okay, and so that's why I think it's important that they have it. The second thing, for key employees, obviously protecting their income, help cover the extra expenses associated with disability, and it provides benefits to these people at little to no cost. Okay, so this is the benefit of having it. Is there a downside to it? Yeah, they can't discriminate. Okay, that may be a downside. Okay, and but beyond that, I don't think there's a lot of downsides on this at all. Okay, you're doing something that, why do people go to work every day? To make an income, right, Keith? And what are you doing? You're protecting the reason they come here. Okay, so let's take a look at another key employees, healthy and working. Today, if they're healthy and working, the business receives a tax deduction for the wage continuation or salary payments. okay, right? They're working, I can deduct the wages, right? The business pays the employee a wage, the employee then pays taxes on their income. That's simple. That's the anatomy of a paycheck. Company writes the check, employee gets it, key executive gets it, they pay taxes on it, and then what happens over here, what? Is that determines where they live, the cars they drive, the school they send their children to, the home they live in, all these different things, okay? That defines the individual financially, okay? So let's take a look now. If a key employee is too sick or hurt to work without a wage continuation plan, okay? Now, the employer, the business rules the employee payments as dividends and not a salary. The business pays the disabled employee a dividend. The employee pays taxes on the dividend. This is important to understand, that in the absence of a plan, okay, of having a formal plan, and the company were to continue to make payments, continue the wages of an individual, can it be considered a wage continuation? At some point in time, it can. Remember, we talked about, well, for 3 months, 6 months, you can continue the wage. But on an extended period of time, there's somebody that walks in the door and says, hey, I don't think you can do that anymore. And who do you think that is? Now it's starting to get a little fishy. It's somebody we call the government, okay? The government's going to come in and say, well, wait a minute. This is not working as we thought it would be, okay? Because the spirit and intent of this is they'll be covered a long-term loss, okay? And you're taking advantage of paying an individual a wage, okay? You're deducting it as a wage, but he's not working for it. He's not working for it, okay? So what happens in a corporate setting when you pay an individual, in particular a shareholder, okay? So at the field, the shareholder, this is more so for you than anybody. If you're paying a shareholder money from a company for them not rendering any services, what does that become? It becomes a dividend, okay? So they don't get the double tax. They get the double tax on once for both the insured business and the employee is going to be double taxed, okay? So you cannot continue the wage of an individual, in particular a business owner of a C corporation, okay, for not performing for the wage, okay? And when you do that, that's just like when you get a stock, when you get dividends, okay? So it doesn't work very well, okay? So it's not, in the absence of the plan, you're creating this for your employee. And this is not where they want to be, okay? So that's if they don't have it insured, okay? So if you have a plan, okay, that is insured, then here's what happens. The cost of the coverage pays for the policy. The employer pays the insurance premium. And remember, it's deducted as a fringe benefit, okay? This is a fringe benefit, just like all our other benefits. Premiums are not taxable to the employee, meaning if the annual premium set for you that we attributed to your cost was $1,800, that's a fringe benefit expense, okay? And it's not going to come back to you on your W-2, or we're not going to show that as a bonus. So you're not paying any tax. So there's no gain loss to you as an employee, okay? But what happens is, when and if you do become disabled, because it's a continuation of wages, just think it through. Wage is a wage, regardless whether it's being insured or not. You have to pay taxes on it, right? So that's what happens. When you get the money as an employee, you have to pay taxes on that, all right? So it's kind of easy to understand. And again, when you look at in the marketplace, how is this most commonly insured? It's most commonly insured through group products, a group LTD plan, both short-term and long-term. So we've gotten the wage continuation thing out of the way. Is there any questions on that? Okay, because you want to understand how that works. In particular, not so much for the rank and file or any other W-2 employee, but you really want to keep really keen interest if you're working a small business. Is the owner covered? Is it an S corp or a C corp? Okay, and do they have coverage? Because what's the end result going to be? That if it's an owner of an S corporation, you can't deduct it anyway. The company can't, so it's going to create a tax-free event, okay, for them. So kind of understand how that works. Now, executive bonus plan, I call this probably the best thing in the world in buying, selling, and owning income replacement, okay? Because it's the best of all worlds, in my opinion, okay? Let's take a look at it. It's informal, non-qualified, and those two words alone make it really cool for me, okay? It's informal and non-qualified, Okay, allows an employer to pay extra salary to executives who uses the money to purchase DI. And the neat thing about this is, so Keith, you want to buy coverage, we'll give you the extra $2,100, and we're going to show that as income to you. You go ahead and buy it, okay? But in practicality, what happens is we write the check for $2,100. We'll give you the policy. You own it. We're the premium payer, but we're going to take that $2,100 and apply that to your income. But let's get to the mechanics of this. But the neat thing about it is it allows flexibility to only cover select employees. I can be anti-selective. I can be discriminatory. I can say, listen, I'm just going to do it for my top 3 of my 12 execs I have in the company. I want it just be for my top 3, okay? Or I just want to do it for my salespeople. Or I want to just do it for these people. Or I just want to do it for guess who? For me, okay? I could be selective, and this is the beauty of it. Ideal for partners, members of LLC and S corporations, because this is the only way, effective way for them to incorporate and utilize the corporate paycheck to pay for benefits like this for an LLC or a partnership. And it helps, again, to help attract and retain key employees. I call this a win-win-win situation for everybody, and I'll explain that to you here in a minute. But when we're talking about, whenever you have a win-win-win, you know, there's a lot of good things that are going on here, all right? And when you look at it, let's talk about benefits of an executive bonus. Let's talk about to the business, okay? Mr. Business Owner, Mrs. Business Owner, this is simple, and you have selectivity, meaning you can do this for whomever you want, however you want to do it. It's pretty cool. There is no formal plan put in place. There's really no paperwork involved, okay? So far, so good, right? This is getting good. Premiums are deducted, but they're deducted not as a fringe benefit. Remember on the wage continuation, we had the fringe benefit? Now we deduct it on a different line item. We're calling it now, what are we calling? Normal compensation, okay? And inexpensive and simple to understand, implement, and administer, okay? So it's very easy to do, okay? Literally can be written on the back of a bar napkin. Not to say you hang around bars, but it's a pretty easy concept. It's not hard to do, okay? What's the benefit to the key employee? Okay, the executives or the business owner of an S Corp. Disability income payments are received income tax-free, okay, which is a beautiful thing. Supplement their existing group long-term disability, and the policy is portable. What's the one thing, though, what's the downside to this? What's the one downside that you see for the executive? They have to pay the tax on the premium. But let me ask you a question. If I can buy and have and acquire for myself a product that is so important to me and my family, okay, that has so much value that I only pay my marginal tax rate for, is that not a good thing? You know, if I were to go, if you say, listen, Keith, you can buy a car today, okay? You pay $40,000 for it, or you take $40,000 and just pay whatever your marginal tax rate is for the fourth, you know? You tell me, what do you think is a pretty good deal? Either way, at the end of the day, what do you have? You got a $40,000 car, okay? So I'm saying this is a great way to buy it. The upside is this, the company gets a deduction, okay? The benefits are received tax-free. The insured owns it, and they get the tax-free benefit. And the upside to it is they own it, but the only downside is they have to pay their marginal rate on it. You know what I'm saying? If you could buy something for 18 to 22 cents on the dollar, I think it's a pretty good deal, okay? And in particular, something that's probably the most important financial product they'll ever own, okay? So when you look at this, I think this is like I always say, it's a win-win for everybody, okay? I know I've been in conversations with business owners a lot, and we talk about, hey, you know, here's all the things if we want to do this, corporate pay. Now remember, with an insurance company, especially on the individual side, okay, what they're doing, let's talk about the savings here on an executive bonus. If the company knows that the benefits are going to be taxed, okay, when your insured receives them, they will issue a larger benefit amount, okay, 20 to 25% more in coverage. So you go from $4,000 to $5,500 as an example, okay? Now, what premium is more expensive, the $5,500 policy or the $4,000 policy, okay? Now, when you visit with a customer, you say, would you rather take $5,500 as income, or would you rather me give you $4,000 tax-free? What would they say? Because when the day is said and done, they just want to know, give me the bottom line. How much money do I have? And at the end of the day, right? They'd rather have that tax-free benefit. So your overall cost for the plan has been reduced, has it not? So the company check that they're writing is less than if it was a taxable event. Do y'all follow me so far? Okay. So we create a tax-free event. Company writes a smaller check. And then a smaller check means how much attributed back to that employee is a smaller amount. So whenever you do this, I think it's a win. There's just so many wins involved with an executive bonus plan, okay? And you reduce cost, because it's not about what I get, it's after taxes, okay? So it's like, when is 60% of my LTD benefit not 60%? After I pay taxes, right? So when is a dollar less than a dollar? When Uncle Sam talks about, touches it first, right? And so that's what you have, when you think in terms of how you do your planning, your overall cost for the plan is reduced. Overall liability to the employer, the executive, is reduced, okay? So it just makes a lot of sense. And all I say is show them both options, okay? Give them a choice, and you see if they choose A or B, guess who wins? You do. So I'm just saying. So let's take a look at how an executive bonus plan works. First of all, they make a taxable bonus. Now the bonus, it could be a literal, they write a check, the company, then the individual writes a check back to the insurance company. But internally, it could be handled a lot differently. It could be showed up as an actual bonus on their W-2. It could show up as a part of a W-2, excuse me. They offer the bonus cash to the employee to purchase the policy. The employee then buys the coverage, pays for the check, the employee owns the policy as the premium payer. Now, granted, they're not writing the check for it, but that's it, okay? But once that employee executive becomes sick or hurt, those benefits from the insurance company are paid tax-free to the executive, okay? So again, like I say, your underlying plan, select, absent a S corporation owner, is taxable, group LTD to 6,000, 7,000, whatever, okay? And for those highly compensated people who, keep in mind that if you have a 60% plan to 5,000 as an example, when do you start experiencing reverse discrimination? That $5,000 benefit only covers 60% of the first what? 100,000 of income. So if you have an executive making 200,000, all right, and he has a 60% plan to 5,000, is he getting 60% of his income? No, he's getting 30%. This is where individual coverage can come in and true up everything. So listen, let's take you from 30 to 60. Let's add individual coverage onto that, okay? Yes?
Is that sometimes in lieu of the group benefit for these executives or in addition to?
I like it to be in addition to. It could be in lieu of, but the problem is when you take an individual, those people out of the group plan, the problems exist that the carriers, let's look at the carrier's perspective. Well, you're taking the best risk out of our pool, okay? So we're gonna rate you a lot higher, or we may not even take it. Okay? Now you've limited your exposure to where you can go for a carrier. You've taken your best risk and taken them out of the pool. I don't see the benefit of that. I would put them at 5,000 and come with individual DI. Now when you start applying that to 6, 7, 8 employees or executives, that's where your carriers are going to start offering guaranteed issue. They're going to say, listen, we'll take all 6 of them. We'll give you $4,000 or $5,000, $6,000 a month, and we'll do it on standard issue, no underwriting. Okay, that's a thing that's occurring today in our marketplace today, and actually very aggressively by a lot of carriers, that they're doing a lot of guaranteed issue stuff. So kind of keep that in mind that, we can sell it at a discount. We can make it easy for them to buy. We could avoid underwriting. Geez, that's a pretty good deal. You know what I mean? So I'm thinking, just have that thought process going in your mind. But the executive bonus plan is so effective. Okay, I could tell you a case where I was in Kansas City working with a relatively large company, and he had 95 executives with the company, and we had started the plan off as a part of a wage continuation plan. Okay, and we got down to it. We're literally at the very, we're ready to cross the goal line with the broker, and the owner of the company looked at the census. He said, "Wait a minute, you're including these two people." And I said, yeah, they're part of your list. You can't be selective on who you do this for. They have to be in there. He goes, I hate these guys. And my first thought process is, if you hate them, why do they work for you? He goes, well, they're great. They're really good at what they do, but I hate them. I said, their biggest pain and, you know, whatever. And if I could find a way not to do this for them, I would do it. I said, well, based on what you've told me and everything we've done so far, there's no way you can avoid it. Okay. And he said, well, then I'm not going to do this. And I said, well, all right, let's back up the train here a little bit. If I could find you another way to do it. Okay. So what I did is I said, okay, remember how we went from taxable to a higher level to tax-free? Remember that? So we changed everything to a tax-free benefit, made it an executive benefit plan. Okay. So we got 93 people instead of 95. And so we went to an executive benefit plan, and he would write the check. He would get the deduction just like he wanted to. He was able to exclude those two guys because it was you have selectivity. Okay, took them out of the plan. And the problem was, though, that all these executives now are getting what? They have to pay tax on that. So he said, you know what I'll do? Because you've reduced the premium by like 30%, I'll pay the tax. I'll pay their tax. So we did a double bonus. And I said, well, there you go. Bada bing, we're in. You know. And so we came back. And so, I mean, there's a lot of opportunity where you have, I mean, it's very rarely you find a guy who just hates people who work for him, but, you know, but I mean, it could happen. And so, I mean, it is, like I say, it's a really nifty way of thinking through and how to create more money at the time of claim for your customer, easy way to pay it, have selectivity, not deal with all the things associated with and around qualified plans, because they can get kind of bumpy and they can get they can get clunky. Okay, so this is a terrific opportunity. So let's compare the options. Okay, and when you do that, understanding the differences and similarities. So if you're visiting with a customer under the wage continuation or executive bonus, who pays the premium? It's a tax-free benefit for tax-free to the individual and the insured, but it's taxable to the insured on this one. We're talking about the cause and effect to the insured. Okay, the disability income benefits to the employer are taxable versus tax-free. Now, I don't know about you, but I would rather pay tax on a small amount as opposed to the potential tax on a very big amount, okay? And you know that this policy can be lower in amount and still have the same effect as it being a taxable event. So you see what I'm saying? When you look at what's important, what they buy, product is very important. Most important aspect of this, the most important aspect of any type of situation is the advisor, okay? You're the most important element in this, okay? And if you don't understand how this works, your people at your company that you work with, they understand this. They get it, okay? So the most important is the advisor, the product they're putting in place, make sure it's product appropriate, okay? And the third thing is look at how it's being paid for. Are we doing it? Are we getting the best bang for our buck in the way we develop and create these plans, okay? So both salary continuation, executive benefits, they're paying the premium. The employer's writing the check. The premium's tax deductible for the employer. And so either way, the employer is a winner on this. It doesn't matter. But I will tell you, if it's a wage continuation versus executive benefit, which check is going to be smaller? The executive benefit, right? Because the benefits are down. Remember, when it's all said and done, after Uncle Sam gets his money, you got one plan that Uncle Sam doesn't touch, and you got another one that Uncle Sam's going to probably talk about a lot. Okay? Yes.
The premium is tax deductible for the employer under both, but up above it says taxable.
Yep. Under the wage continuation, as the employee, the employer's paying the premium, but it's tax-free for me. There's no tax liability. I'm not paying any taxes on that premium. Okay? You follow me? Under this plan, I'm paying tax on it.
Oh, that's what the employee.
This is for the employee, huh?
Oh,
right?
For the employee.
Right.
Okay,
and this is for the employer down here. Okay? You follow? Okay.
Yeah.
Perfect. Any questions? Any more questions on that? Okay. So, help them find the best solution for them. Okay? Under the wage continuation, we're covering a broad range of people, best ideally suited for group long-term disability income plan. Okay? Tax-free premiums, taxable benefit payments, requires a formal plan. Not a bad thing. Okay? That's fine. But the neat thing about under that plan, you're covering those individuals who are most generally disenfranchised from our market, okay? Which I think is very, very important. Executive bonus covers only a select group of people. This may be your highly comp C-class people, Number two, tax premiums and tax-free benefit payments. And there's less formal, there's very little, if any, paperwork involved, okay? Or any type of reporting, okay? So there's a lot of benefits to both. But like I say, I think when I'm in the marketplace and I could find a way an executive benefit plan can work, I try to find it, okay? I really do. Let's talk about solutions. Individual disability income is a terrific plan to supplement group long-term disability for those individuals who are out there in the marketplace. We've talked about that. When it's 60%, not 60%. Obviously, when it's capped, when it's taxed, or if you have a cap on the benefit, maximum benefit, and your earners make more than that, it's going to be a bigger reduction. And then start the conversation. Could you continue to pay your disability employees salary if your business? Okay. How long could you afford to pay them, and how will you pay those payments, and are they deductible or not? So these are important questions to ask a business owner. Now, as an individual, if you became sick or hurt, what are you going to do? Have that conversation. Hey, if one of your key employees were to become sick or hurt, what are you going to do? How are you going to manage that? And if they say, well, they're really not important to our company, whether they work or not, I don't know about you, but I could find other things to do with $40,000, $80,000, $100,000. You know what I mean? If he's not employing, why is he working for you? Okay. So, and like the business owner, their first comment, when we talk about business owners, it's funny. You talk to them and they say, I don't need it. My company can continue to pay me. Okay. So what you're telling me, Ken, is this: you don't need to be here, and you could still earn 100% of what you're earning today, right? Is that what you're telling me? Let me ask you a question. Why are you here? Okay. There's a lot of other places I'd rather be. Golf course would be one. Okay. Or any place that had golf courses in the winter. Really think it through. It's just, if you repeat to them what the silly comment they make. Okay. So really, Ken, what you're saying is you add no value to this company at all, then, do you? You're just kind of a load, but you have a great parking space. I'm just saying. Okay. Doesn't make sense, does it? No. But let's talk about other things too. Let's talk about combining group and individual. We've seen this before. You got a person who's making $350,000 a year, okay, bringing home $18,000, but their LTD is only covering them to $10,000. Now that can you see the big difference here? How where now you have a big gap. All right. Now you got a guy or gal who is making just under $19,000 or bringing home $19,000 a year. Oh, by the way, when you're bringing home $19,000 a year versus $19,000 a month versus $1,900 a month, you're still spending it all. Okay, trust me, doesn't matter. You're bringing home $20,000, you're spending $20,000. Bringing home $2,000, you're spending $2,000. So either way, now you're down to 64. That's 22%. That's ridiculous. Okay, this is where individual coverage can help fill that gap. Okay, help them fill that lifestyle. Because I will tell you that if you're talking to an income earner making $350,000, I could probably say without doubt, if you put 10 of them in this room today, only one of them would know that their LTD is capped at 10,000. Okay, only one of them would know. So you sit down with them and say, listen, what would happen if you became sick or hurt? What's your plan? If he tells you he has group, let's say, okay, let's just take a look at page 2 of your benefit booklet. Okay, and let me point something out to you. I've been in situations where I've been with customers who are making this kind of money, and you know what the LTD cap was on their benefit? $2,000. I'm going, hey, are you kidding me? Oh, he goes, it's cheap. Well, no wonder it's cheap. Really? But it's just like, well, but I got 60% of my income covered. No, Batman, you really don't. Let's talk this through. So, but there's another option. Okay. What are you doing on your, well, that's pretty cool. What are you doing if you became sick or hurt? And obviously we've covered your income, but one thing has stopped, right? And that's your income or your retirement plan. Okay. So let's say you're 30 years old and you've been putting money into your 401k or qualified retirement plan, 5% rate of return. You're going to retire it at 65 and you're putting $2,000 a month away. If you became sick or hurt at age 40, now remember, whatever money's in there does what? It still stays there until you reach age 65. So you got $1 million. But what did you lose? Okay, from all these contributions going here, $1.2 million out of your retirement plan. Okay, so this is an additional plan. And when you look at and you combine these plans together and you kind of put them all together. Okay, hold on a second. There we go. Well, let me explain the DI retirement security. The disability income trust products that are in the marketplace today are products that says if I become sick or hurt, I'm going to get a $1,500, $2,000, whatever, but I'm not going to get that money. That money is going to go and pay directly to a trust, okay, on my behalf in a non-qualified way. Because if I have all the disability I can have, let's say if I'm making X amount of dollars and I can't buy any more coverage, okay, but I have the wherewithal to say, you know what, I got a very healthy and robust retirement plan, and if I become disabled, obviously I've got my income covered to cover my expenses, but what about my retirement contribution, either to my 401k, or it may be I'm buying farmland, you know, Iowa farmland, you know, over out west now. It's pretty cheap, but I mean, it's a little sandy, but it's cheap, you know. But let's say I'm buying farmland, and I choose to do that. Well, how can I protect my retirement contributions? So as an employee, you purchase a policy from a carrier that says, I'm going to pay you X amount of dollars if you become disabled, and those dollars won't go to you, Linda. They're going to go to this trust, okay? They're going to go into that trust tax-free, okay? So when you reach age 65, what happens at most policies at age 65? They're only guaranteed non-candidate age 65, right? So at age 65, now all these monies are going into the policy. Now you have a large pool of money to do what? Recover what you lost from making those contributions to your 401k or a retirement plan, okay? So that's how that works. Do you guys get it? That seems a little bit confusing. You'll kind of, but I mean, it's basically says I'm going to protect, obviously, individual disability or group protects my income. The retirement trust products protect my retirement contributions, okay? So you take a percentage of your income, that dollar amount goes into your if you become disabled, it goes into the trust. They manage it for you when you turn age 65, just like your 401k people do, right? The 401k is not, you don't put money in to take it out next month. You put it in to take it out when? At retirement. So when you retire, we're making those contributions for you because you can't, because that 401k is a function of what? Earned income. You have no earned income, and let's go back to those math equations. You take 100% of zero, it's zero, right? So nothing's going into the 401k, so I've replaced those contributions. It's a real neat plan, yeah.
Is that a rider or is it separate?
It's a standalone policy, yeah. The 2 or 3 carriers have this in the marketplace. It's standalone, yes, yep. So it's kind of a neat look, yeah.
Is that tax qualified? Are you saying that?
Non-qualified. The money, you're buying it, you cannot deduct the premium, okay? With after-tax premiums, the money, you pay the premium, the benefits are tax-free. However, the money that is growing in the plan each and every year, the gains on that are taxed, okay?
When you get to maturity, let's say at 65, it ends, you get a certain amount of it, the gains are going to be taxable as ordinary.
Well, any gains that you haven't paid for every prior year, right.
Can you repeat that question for people?
Oh, the question is, when you become, there's 2 questions. Can the premiums be deducted and what happens to the money going in? And the second question is the money taxed when you take it out, or what's the tax implications as it grows and goes into the plan? Number one, it's not a deductible product, meaning the premium has to be paid for with after-tax dollars, okay? So you take the premium, whatever, you just write the check, it's after tax. So now the individual, when they become disabled, now this is after let's say they're getting $2,000 a month, okay? That $2,000 a month is paid directly to the trust, the trustee of the plan, okay? The trustee then will manage the money, just like an employer will manage a 401k, okay? Where you as an individual, you can say, I want to be in an aggressive fund, you know, whatever, okay? So they're managing the fund. At the end of the year, whatever their growth of the plan has been, those dollars that were attributed to the growth of that year's plan are taxed. Okay.
Oh, then.
Then. Okay.
At the end of each year.
Right. Now you could have if you choose, let's say, for instance, your customer says, you know what, I don't want to pay tax on money I didn't receive, because that's what he'd be doing, right? You can put it in a deferred plan, saying, I want to defer all my taxes until later, just like they do with a 401k, okay? So the money's deferred. You can either have it deferred, or you can pay tax every year on the growth, okay?
If you pay tax on it every year of the growth, then I hit 65, I get this pile of money.
Mm-hmm.
I can do whatever.
You can give it to me. I'll give you 10 points. But I mean, it is, yeah, basically it's money that you've already paid taxes on. Kind of like, like I said, I'm not a financial advisor kind of guy, but I think you call it a Roth IRA type of thing, you know, so, but that's how it works, okay? Are we running close to time? We're doing all right?
We are, but you've got one slide left.
Okay, how it works. So let's take a look at, let's take a look at the anatomy of a disability. You got your sick pay, vacation, short-term disability, long-term disability, retirement, individual. So these are the types of things that you can help them build upon their basis for the group in the short term. And this is how a successful plan could look. So we're done? Are we done? No? We're still? Okay, well, we are done.
Can you show that slide again?
Sure.
Thank you, Rick. Before we close, I'd like to turn it back over to Brian in Falls Church for an additional poll question. Rick or Brian?
Thanks, Keith. We have one more polling question for our virtual viewers. Name the presenter from today's program. Name the presenter from today's program.
Helps you all out.
Try to make it difficult. Please use the polling function on your screen to respond. You will have 2 minutes. Once again, thank you, Rick, and thanks to all who participated in today's edition of NAIFA Live. Don't forget to mark your calendar for the next meeting, April 18th, hosted by NAIFA Minnesota and featuring Jonah Stillman. For those who have joined us virtually, this concludes our program. For those who are participating from a viewing location, we turn you back to your local meeting. My name is Brian Money, and on behalf of the NAIFA Home Office staff, I wish you a great day and a pleasant tomorrow. Thank you.
The carrier, okay? What you're going to find, top jobs are going to be
Like electricians or something.
No.
I don't know.